So I'm going to jump into it then. I'm going to go over the job order costing and analysis now. So we're going to be using some of the concepts from chapter 1 in order to figure out how much a job costs. Again, we talked about the conceptual, analytical, and procedural ways that this information is going to be shared with you. Goal here is figure out what is job costing, how do we use that to price services, and then what are the steps we can make. So 2 big concepts we're going to be talking about in this class, and this is really your first midterm, is the difference between process costing and job costing. So you can think of this first midterm is how are we using all these cost concepts to apply them to different types of business models. While the second part of the class is going to be talking more about forecasting, budgeting, and planning. Process costing refers to the business model. How do I say it? Like water bottles. When we have a lot of uniform goods that we're going to be selling, how do we figure out the cost of each product and then figure out the price for which we sell it? So water bottles, soda, cars might even, if we're making a lot of one type of car, that's like a process. Job costing is customized products. So if this is like, I use it for consulting, like how do you cost out a consulting job? Or if you are going to be building a custom house or like fixing the flooring of a house, like you have to figure out the cost associated with that. A lot of construction work is done with job costing, while process costing is a lot of like manufacturing work. So used for the production of large, unique, and high cost items, job costing. So I'll use this if I have like $1 million consulting engagement. I would have to figure out all of the different costs associated with that consulting, like the systems costs and all of that, to build out like a price or proposal. Something that's customized or built to order for the customer. And then many costs need to be traced into the job. So here's an example. Job versus process. Job is heterogeneous, low production, high flexibility, not standardized, while process is very standardized and repetitive. So production activities and job order costing. We have all our manufacturing costs, and then we have to flow them to different jobs, right? Because we want to see if the job is productive or not, right? If we are making money from that specific job. So here they're saying like there's some companies making custom cars. So they take all of this materials and they flow it to different jobs. This is like job B15, 16, 17, 18, 19. Flow it to each job, normally like on a job costing sheet, and then see how it flows through all the traditional processes of work in process, finished good, and cost of goods sold. So it's still the same cost flows. Like the theory from the first chapter flows through. This is just a reminder. And this is why I like going through the chapters quickly. There's a lot of repetition. It's kind of a waste of time, in my view, of raw materials, flow to work in process, flow to finished good, flow to cost of goods sold. The main difference with job costing is then we're going to record all of these onto an individual job. So job 1, job 2, job 3. At my consulting firm, I'm saying this because I know consulting very well. If I'm consulting for technology company 1 versus technology company 2, I need to know the resources I'm using on each of those to see if I'm profitable. So job cost sheets and how they are used in job order costing. So a lot of software will help us determine what products and services we're using on each job. And that's a job, we call those job cost sheets. There's a lot of other technology that can help us today too. Sorry, I'm a little sick, so if I'm rubbing my nose or like coughing a little, that's why. Not COVID though, if anyone's concerned. Customer's name, Carol Connor. So this is kind of information like, hey, what's a customer? What job is it? We're building an alarm system for a specific car. And then what are the costs? Well, for any product, we have our direct materials, our direct labor, and our overhead. So we're going to be tracking every time we use one of the products for the job, we'll track it on this sheet. Anytime we use the labor, so our timesheet, well, there'll be timesheets where people your employees write in the amount of hours they're spending on a specific job. And then overhead, we have to make an estimate. I'll say, well, here we're saying 160% of the direct materials are overhead costs. There's some kind of overhead associated with it. Maybe and we'll go into how we develop those estimates in the future. Just know that we apply overhead to the job. That way we know how much the job costs, and then we can add some kind of premium to it to figure out the price of the job to see if it's profitable or not. So we're tracking all that stuff we talked about in chapter 1, materials, labor, and overhead, over to the specific job. Does that make sense? Any questions? Okay. So high level, right? This is actually like, I hope it's a simple concept. It's like, what's the question here? If I am making custom work, how do I know how much I'm spending on that custom work? And then we just, how do you know? You just have to track all the costs associated with it. And what are those costs? Materials, labor, and overhead. That's all these questions are going to be. It just gets more complex with the different business models. So the flow of materials can be complex for a business. Right? Like we purchase materials. First we purchase it. And then a department might request those materials. So when they receive the materials after the request, which is like a requisition request, they receive a receiving report. A receiving report tells you all of the materials you received. And then we have ledger cards, which we use then to track what jobs they move on to. This is all done automatically now for most systems. But if some companies are a little outdated, they might do it on paper. So here's an example of a materials ledger card. They say, okay, for the alarm system wiring, we have this many that we received, this much we issued, and here's the balance and the price related to it. This is like, nowadays, this would just be in a system, right? You go in a system and see how you can find all this information and what jobs it's traced to. And this is a requisition, like how much we requested. That's a requisition. Like I said, we ask. So the department A asks for this amount of materials from corporate, and then they track all of that and apply it to their job. So whenever that department gets the materials, they add it to their departmental general ledger through this journal entry, which is what was asked about earlier, where you just transfer it out. So we credit our raw materials and we're going to move it to raw process because we worked on it. Work in process. So we move from raw materials, work debit. So debit work in process. That means we're working on it now, and we credit our raw materials. It's no longer just sitting waiting to be used. Remember, we'll go back to, if you need a refresher on financial accounting, I have a lot of videos on it. But remember, like inventory is a debit normal balance. Debit normal balance increases inventory, credit decreases. These are both inventory accounts, so it's just reshuffling an asset on the balance sheet. So describe and record the flow of labor costs in job order costing. So the flow, this is going to the detail of what we talked about. Employees are going to put time tickets. That's direct labor, right? Like an employee is going to say, I work this many hours on this product. That's going to go on the job cost sheet. There's a salaried employee, like a supervisor, that's also overseeing all these people. It's going to go into indirect labor, which is in factory overhead, and then needs to be applied to the job. Right? You can't track a manager's time to each job. It's too complex. So we kind of make an estimate. So here's an example of a time ticket. This would normally be online, where here Mr. Zeller or Mrs. Zeller spent 3 hours on this one product. And so we track the cost of that. If anyone's ever taken their car to the shop, right, like to get a repair, this is what you get, right? You kind of get like an invoice of, here's all the costs, and here's the hours worked on. I worked on it, like, and then they give you a charge and then a markup. That's exactly what this is. It's just a job cost sheet. Like repair shops are job costing basis. And then if they're working on this job, so they're fine, hey, here's direct labor. So let's say all these different employees put money on these different jobs. Here's the total direct labor. It gets added to our work in process inventory. So the trick here is it's not an expense, a period expense, right? It's not G&A, it's a product expense because they're working on products. And the indirect labor would become a period expense, a G&A expense. Or sorry, the indirect labor might become factory overhead, or if it was made for period expense. So we'll go into that in detail. Describe. So the other costs, right, are the overhead costs. Like we talked about, supervisors and managers who aren't directly attributable, or electricity. How do we estimate how to apply these costs? So let's say there's a manager that makes $100,000 a year overseeing a lot of different jobs. How do you apply that to his cost to these specific jobs? Because he's not working on these jobs, he's overseeing them, right? But what we do is, you do this for anything. I want to take it really high level. You make an estimate. That's all this is. It's how do you make a good estimate? Well, first you have to set a rate. So what is the rate? Your estimated overhead costs. So like, what do you think like the costs are based on how much the activity is? Then, so you might say it takes about 2 hours of the supervisor's time to oversee every job. And he gets paid $50 an hour. So the rate is about $100 a job, or 100, or we could even say $50 an hour, and then, or $50 a job, and then 100 jobs, and then you apply it, right? But that's an estimate. You get to choose that, and you normally base that off history. I'm not going to ask you to determine an overhead rate here. I'm going to tell you, like, the overhead rate is determined by this activity base, and then you go out and have to go calculate it. So I just know in practice that this is a true estimate. And then as you make your estimates, you kind of check on them and see if they're reasonable or not. So here's estimated overhead costs based on estimated activity. So here they're saying the predetermined overhead rate is 1.6. So they're saying for every dollar of labor, there's 1.6 times the amount of overhead. There's much more complex ways to make these estimates, which we'll go into later. But for this job costing, you don't need to know them yet. Just know that we make a rate. And so here they're saying it's 1.6, which means that for every dollar we spend on direct labor, we're estimating that it costs about 1.6 of overhead. So like, how would we make a reasonable estimate? If it's a very labor intensive job, it makes sense to use labor as an estimate. And then so we take the total direct labor amount, the 4,200, multiply it by 1.6, and we get our journal entry. Then that overhead isn't a period expense anymore. It's not on the income statement. It goes into inventory, our work in process inventory, right? Because it's applicable to a job. It's applicable to a product. So we debit our work in process inventory, $6,720, and we credit our factory overhead, $6,720. Now something interesting happens here with estimates versus actuals is we actually get our bills, right? Like this 1.6 is an estimate as we're doing jobs, but then we pay our salary at the end of the month, or we pay our electricity bill. It might be different. So let's say we use too much indirect, we use too much raw materials. We wind up using more raw materials than we estimated. We'd increase our factory overhead by that amount. So we debit factory overhead, credit raw materials. Or let's say we actually paid more wages than we estimated. We increase our factory overhead by the amount we underestimated. Same here. This is actuals. Like, oh, we actually spent this much on overhead. We debit our overhead. So what we're doing is we're making an overhead bucket. We're applying all our actual expenses to it. And then we're allocating that overhead bucket to our estimated jobs. And then if there's a difference, we'll adjust for it accordingly. Does this make sense?
A quick question. The factory overhead, is that on the balance sheet?
So the factory overhead is always going to be applied. That's a good question. It's either should be it should be in our inventory somewhere,
Okay, all right.
right? It goes back to our product cost, direct materials, direct labor, and factory overhead.
Oh, right,
It should be a
okay.
part of inventory. So it should be in one of our inventory buckets, right? The beginning, work in process, or finished. It shouldn't be in beginning. It should be in our finished goods or our work in process.
Okay,
So we have to figure out if we're over or under, it should be applied there. Does that make sense?
yes, thank you.
No, good question. So here's the cost flows again. We've seen this a few times now, right? We get time tickets, direct materials, then we add in all the other things, the direct labor overhead goes into our work in process. We have our finished goods that goes into our cost of goods sold. Is this something we've seen this 3 or 4 times now in these slides? So just make sure you understand that flow. The real flow here is, remember, these are product costs, and inventory has a cost of goods sold. That's when it's expensed when we sell it, right? The only additional step we're saying here is in job costing. We then take all of these and we apply them to specific jobs, right? So we know if the jobs are profitable or not. Is that making sense? That's the next step we're doing here. And you can do a bunch of journal entries related to it. They're all just debiting. These are just debits and credits related to the costs. So we're always increasing the inventory cost and then crediting either our liability or the asset it's coming from. Schedule cost of goods manufactured. I mean, this is the same we've seen before. And then this is what I was mentioning is there might need to be an adjustment if we over or under applied the amount. And so, like we said, we're going to have to increase the inventory or cost of goods sold related. Concept there is because we're using estimates, right? We're using estimates. So because we're using estimates, sometimes we're going to be wrong. We'll either overestimate, almost every time we're going to be wrong, right? Like no one's perfect at estimating things. So either going to overestimate or underestimate what you actually spend. If you overestimate what you actually spend, you're going to have to make the adjustment, and you're going to have to, lower your cost of goods sold, like the flow through. While if you underestimate, you're going to have a higher cost of goods sold. Underestimating meaning we spent more than we actually used, or actually applied. Sorry, used versus applied. So that's something that you need to sit with and practice on the homework, is like, get the concept. We estimate first because we need to plan on day one, and then we get our bills afterwards, and then we have to make our adjustments for the actuals. And how do we do those adjustments? Just here. It goes to cost of goods sold, which is the flow through of inventory. So here we estimated that our estimate was $480 short. We actually spent $480 more than we were estimating. And so that $480 is now a cost of goods sold. We're going to flow it through, or you could assume it goes to inventory, but here we're assuming it's going to cost of goods sold, right? We sold the products, so we're assuming, oh, that cost should be associated with it. You can also do it for service firms. That's all this is saying, right? You can do it for consulting as well. And just, you're not going to have the direct materials associated with it. You're just going to have direct labor, and you're going to have more detail around your direct labor. Service firm being consulting or like a repair shop. But and then if the repair shop is using direct materials, then they're just going to be adding direct materials to. Let's see. So here's a way like you'd price a service. So let's say this is an advertising company. And so this is useful, right? If you're tutoring, or if you want to make some kind of consulting company, this is how you would go about doing it. And I do that. I help consultants quite a bit. I have a few pure consultant clients that I help them with their business. And they're saying here, for a job, an advertising job, they need designers and staff. Their designers are 43. They expect cost $65 an hour, and they're estimating 43 hours. Their staff, or that's the actuals. The staff are at $50 an hour and 61 hours. So the total direct labor is 5,845. And then they have overhead related to these designers. Maybe that's like the software they're using or the electricity, and 96 related to their staff. And maybe these are the offices they're using. And so this is how they make the job cost. Make sure you know that's not different from the price, right? Like the cost is how much it costs the business. The price, there should be some markup on this if they want to make money. Right. This is a relatively quick chapter. The reason I paired it with the first chapter is the first chapter is very conceptual. Like to what someone was saying before is like, where are the formulas? How are we using this information? So the first chapter is going to help you practice understanding like how to bucket the information and how to have your frameworks. Hey, we have direct materials, direct labor, factory overhead, indirect, direct costs, kind of getting that. And then how do we start applying this information? The easiest way to apply it is jobs as a first, because we know every job has some of these traceable costs, and then we just have to apply factory overhead using some predetermined rate. I'm not going to expect you to know the predetermined rate, like how to calculate it yourself, or how to determine it. It's going to be pre-given to you. You'll just have to know how to apply it and then how to make your adjustments. So I think these two chapters pair pretty nicely. It gives you the concept and it gives you some application. Any questions related to this?
So I am seeing that for the credit, isn't it on the left side or the right side?
Yeah, so I highly recommend debits are always left, credits are always right. The Accounting 101, the previous accounting course, is a requirement for this. And so like I'm expecting, so if it's been a while since you took it, or if you just need a refresher, highly recommend, I have it right here. So let me walk through some resources. I'm gonna stop recording and I'll share the lecture with everyone.